From the Algo Index Desk, this is the market close for Tuesday, the 4th of August. Here are two things that finish the day together and are not supposed to. The S&P 500 closed at a brand new all-time high, 7736, better by 1.8%. And the market's gauge of fear closed up almost 4% on the very same session. Records are usually quiet affairs, where the price of protection drifts lower as stocks drift higher. Today, protection got more expensive while the index set a record. And there is exactly one thing that reconciles a bought-up market and a bought-up fear gauge at the same time. Demand so aggressive, it lifted the price of stocks and the price of options together. The S&P took in about $16 billion of net call demand today, the single largest day of it in a month. And traders were not buying calm, they were chasing the upside with both hands. That is the whole session in one sentence, and the number under it is the part your screen never printed. Three forces ran underneath today's record, and I will count them down. 3. The flow itself, $16 billion of it, and the pocket of dealer positioning at 7,700 that turned an orderly climb into an acceleration. 2. The single options ticket that paid 40% in one session, flagged in the morning before the stock moved. 1. The reason a record day left protection cheaper than it has been almost all year. Stay to the end for the one price that decides whether tomorrow extends or stalls. Run the marks. The S&P settled at 7736, up 1.8%, about 136 points, on a session that traveled roughly 128 points high to low, and printed its record at 7758 late in the afternoon. The Nasdaq did the real running, up 3.4% on the tracking fund, more than 1.5 points of leadership over the broad market, and the Dow closed at a record of its own. Now, the piece that argues with all of that green, the fear gauge rose to 16.5, up close to 4%, and its companion measure ticked up too. Count the open contracts, and it still leans defensive, puts outrunning calls by about 1 1/3 to 1. But measure what people actually paid for that downside cover against everything across the past year, and it is close to the cheapest it gets, roughly the 19th percentile. So, the scoreboard's real message is a mismatch. A record close, cheap insurance, and a fear gauge climbing anyway. Those three do not usually travel together, and the rest of this show is why they did today. 3 engines lifted this session, and they stack from the visible to the hidden. Start with the news, because it is the part everyone saw. Optimism that the Strait of Hormuz could reopen sent stocks to records, and it did it by working through oil first. A proposal to restore shipping has been drafted. Officials on both sides sounded confident, and crude fell hard on the prospect, West Texas settling near $76, with the global benchmark slipping under 80. Falling oil pulled the 10-year Treasury yield down to about 4 6/10%. Bonds rallied, and lower energy plus lower rates is a clean risk-on cocktail. That is the surface story, and it is real. Second, leadership, and it was narrow and violent. Semiconductors did almost all of the work. The chip group jumped about 7% for its strongest 4-session stretch since 2020, most of why the Nasdaq ran 3%, while the broad market managed under 2%, with Palantir up about 30%. When one group carries this much of an index, the advance is more powerful and more fragile than the headline admits. Third, the makeup of the buying, the one engine no price chart can draw for you. The S&P recorded about $16 billion of positive delta notional today, driven mostly by longer-dated call buying, the largest positive reading in 30 days. The Nasdaq printed about $8.5 billion of the same, also a 30-day high. Both indexes at once, both weighted toward calls that live for weeks, is traders reaching for the right tail with real size, and the real-time hedging flow panel peaked near $7.5 billion intraday, in the top 10th of its range. When demand pushes both price and implied volatility up together, you get a record made of buying, not of calm. Put up today's real 5-minute bars, because the entire session organizes around one number that most screens never label. The cash index opened around 7630, a touch above Monday's close, and then it did something unusual. The low of the whole day was printed in the first 5 minutes and never revisited. From that opening low, the market simply walked uphill, bar after higher bar, straight through lunch and into the afternoon. Now watch what happens at 7,700. That level was a thin spot in dealer positioning, a pocket of negative gamma, and when price pushed up into it, the hedging turned from a brake into an accelerant. The advance did not just continue through 7,700, it sped up through it. Because a 15,000 lot customer long call position, parked right at 7,700, was closed out during the climb, so that demand lifted away and the path cleared. Price ran to the record high at 77.58, just before 10 to 4. Then eased about 22 points into the close at 77.36. So the map for tomorrow is short and clean. The record at 77.58 is the first cap. Beneath the close, the first shelf is 77.22, and just under it, 76.99, the support the market vaulted today. Lose those, and the next pull is the settlement magnet at 76.35. Every one of those is a positioning line, not a round number somebody drew. Here is the single loudest options bet on the board, and it was visible before it paid. In the morning's flow record, about 50,000 August 60 strike calls on a memory chip name went up bought to open. The stock, DRAM, then rose 7% on the day, and those calls ran from $2.20 to $3.10, roughly a 40% gain in a session. That is the trade to remember, not because you should have chased it, but because it's a clean picture of where the aggression lived today. In the chips, in call premium, in size, and early. The right tail reaching we saw at the index level had a face, and today its face was a semiconductor call. Slow down here, because this is the tension that carries into the rest of the week. On a day the index set a record, the price of front-month protection is still parked near the bottom of its yearly range, around the 19th percentile. Read that plainly. Even as the fear gauge itself rose almost 4%, the options market is not paying up for near-term downside protection. The demand went into calls, into reaching higher, not into hedges. And underneath, the fixed strike surface actually firmed by 2 to 10 volatility points, the third session running, where stocks and volatility rose together. So you have a market that is expensive to chase and cheap to protect at the same time. If you are constructive here, that cheap protection is a gift, because you can define your downside for very little into a calendar that turns dense fast. A private payrolls read and a services survey tomorrow. The government jobs report Friday, the inflation print next week. What today does not settle is whether this record is the first step of a fresh leg or the last push of a 4-day chase. And the split personality of the data, roaring call demand on one side and a climbing fear gauge on the other, is precisely why that question is still open. 4 signals, 3 winners, 1 break-even, no losses, and the flat trade is the one worth a minute. All 4 were single-leg long options, where the premium we paid was the entire risk on the table. And on a day that only went one way, 3 long call trades simply rode the trend to their targets and booked. The 4th was a counter trend put fade taken mid-morning, and it settled back at flat instead of going red, which on a record melt-up is the result you want from a trade leaning against the tie. There was a 5th setup, a late long trigger in the afternoon, and it never filled, on purpose. The target traded through before the entry could arm, so the system stood aside instead of chasing a market that had already run. Last week, this seat told you to make crude oil the first chart you pull up, because energy was steering everything. It still is, and today it steered in our favor. Oil fell on the Hormuz news, and that decline is a thread running straight through the bond rally and the record close. Process over prediction. We caught the trend where the trend paid, and we did not force the one spot it did not. The bias into tomorrow stays constructive, but it is a bias with a leash. As long as the market holds the 2 shelves just under today's close, 77.22 and 76.99, the structure that produced the record is intact. The magnets tell you the pull. The 1-day settlement magnet sits at 76.35, about 1 1/3% below the close. So a quiet session drifts down toward it rather than up. Overhead, the first real resistance is today's record, at 77.58. Then the computed levels near 77.86 and beyond. The daily strength reading is not yet stretched, so there is room, but price is extended after a 4-day run, and that is a different kind of risk than an overbought gauge. The calendar is the pressure. A private payrolls report lands at 8:15 tomorrow, a services survey at 10 with its inflation component watched closely. Then the government jobs report Friday and the consumer inflation print the following week. And the real swing factor is the leadership itself. The chips that carried this record had one of their biggest names fall about 7% after today's close, even after beating and guiding its next quarter above expectations. Because the market is demanding still more from artificial intelligence spending. If the semiconductors gap lower in the morning, the exact engine that built the record is the thing under pressure. What changes the bias is simple. A clean loss of $76.99 hands the market back to the sellers. And a chip group that opens red is the early warning. Before you close the app, 3 spots worth a bookmark. The trading journal opens free at members.algoindex.com/auth/signup. And every setup you log there gets scored against the exact prices your screen showed at the moment you clicked, the green marks and the red ones both. How our dealer levels actually behaved is posted out in the open at algoindex.com/tools/gamma level accuracy, so you can grade the map with your own eyes. Tonight's full written breakdown lives at algoindex.com/blog, and the community is over on Discord, taking it apart line by line. As for where to aim tomorrow, take it in order. Semiconductors first. Pull up the chip group before the opening bell, because the leadership that made this record is also its softest point, and one large name already slipped after the close. Then it comes down to a single shelf, $76.99, the support the market spent to set its record. Hold above it, and the right-tail chase has another day. Lose it, and today was the top of a 4-day run, and nothing more.